Let me start. Good day to one and all. This is Dr. Sivaram of iknowindices.com. Now I'll be presenting the webinar Tracking Live the Forex Market Together. It is part 2. Part 1 I presented between 9 and 10:50 p.m., 10:50 GMT. And during that time, I was explaining to you the simple live market tracking technique and also the trading strategies and taken the positions. Now between 14 and 14 and 15 GMT, I'll be showing you the results of what happened to the trades which I proposed during that of the part 1 of the webinar, and also explain to you further how exactly we can read the intentions of the players based on the market moves and effectively use the trading strategy to earn consistently from that of the market. This webinar I give once in a month as a twin webinar. So here I explain or focus more on the trading strategies, market reading and the trading strategies. Besides, I also take the live positions and show you the results and how I handle the position also I explain, so that you'll be able to understand how we can proceed using my trading system. So I will just go to that of the slide wherein I propose the trade during that of the early European session. So I was explaining to you that I will take a buy position in the case of euro when it was making a downward move but not breach the low at that time. Then I was showing you the forecast that during that of the European session, the market is expected to swing and firm up and then subsequently swing and drop during that of the US session. So what the players have done, so even though I had taken a buy position instead of waiting for the rise to take a sell position, since I'm using the hedging, I can always see that the positions can be closed. Either the buy can be closed first or the sell can be closed first, depending upon which way the market is making the move. So in the case of euro, before that of 13:30 GMT, the data release time, when they quickly made a gain, I just closed it with 6 pips profit, because after the data release, they will make some volatile moves. And also, I was able to see that they are not gaining above that of the initial low. 1.0566 was the initial low. They are not gone above that. So I just closed it at 1.0555. In the case of GBP, I took a buy position near that of the low 1.2422, and I kept a limit order that got filled, and then subsequently I was expecting the small form of move, but they hardly gained about 2-3 pips and then started making the slide. So I was not able to close the position, but I got hedged. Now how do we handle the hedge? This is very important because all the trades cannot be successful all the time, and it can fill the hedge also. So once it came down and filled the hedge, I saw that the market is making a dip further and the hedging was making profit. So immediately I kept stop at entry in the hedge and wait for the market to react. If it comes down further big, then I'll be able to close this buy and book profit on the sell side. But they formed 1.2384 and stopped cutting the new low for 10 minutes. Then immediately I kept the stop at entry and that got closed. And they started gaining the level. So I kept the new hedge order at 1.2362, 30 pips below. And now when they gain, I will slowly rise the hedge order. So if they gain another 10 pips, I'll rise 10 pips. If they gain 20 pips, I'll rise 20 pips. The hedge order until I'm able to keep stop at entry. Then in the case of yen, So I kept the sell limit order that got filled when they went up to 114.61 and then started making the slide. And I saw that before the data release, I should close because 13:30 is the data release time. They will bring in the volatile move, and also they are expected to make the drop during the European session, sorry, US session. So I closed the USDN position at 114.43 and 15 pips profit was realized, and then subsequently they had taken up the market on the higher side. Again, they will make the slide during that of the US session now. So during the US session, the forecast, expected forecast is, now it is a gap time. 14 to 14:30 GMT is the gap time. So 15 minutes of move during that of the gap time indicate that they are firming up Euro and GBP in order to make a dip again during that of the early part of the European US session, and then they are expected to slowly firm up during that of the US session. So this is the fine tuning of the forecast. Because they are expected to make the slide in the case of GBP, I was telling you that they are breaching their new low, but subsequently what happened, they made only a sluggish move and the net change was only about 75 pips. Whenever they make only the 75 pips net change level, not breaching below that, then they are likely to reverse the market. And here again, in the case of Euro, they just dropped only about 45 pips. So nowhere they made the move beyond 75 pips net change level. That means it was only either way stop ins. They just made the knee-jerk reaction for the data release, and then subsequently they are expected to reverse the market. So this we need to understand. So I kept stop at entry and the hedging got closed, and then I'm waiting for the market to go up. Then in the case of Australian dollar, I was telling you I'll do a breakout trade 76, 79, but they went only up to 81, just 3 pips above that, and then started making the slide. I got hedged at 76.49. All the time we may not be successful in closing the position. So in the event we might be hedged, and once it is hedged, then it came down to 76.37. I kept stop at entry there, and then subsequently they have gone up and closed the hedge. And I kept the new hedge order 76.19. I will trail the hedge order upward as they gain the level, and it was showing positive net change during that of the European session, Japanese and the European session, and now they are showing negative net change in the case of Australian dollar. It is a false move during that of the gap time. So they intend to gain the levels again during that of the US session. So we fine tune the forecast. The forecast says that they are expected to make a drop, but the drop has happened only during that of the closing of the European session because of the data release. So, and subsequently they are expected to make the slide or a dip during the start of the European session, sorry, US session, and then subsequently they are expected to gain the levels. So based on tomorrow's forecast, so they are expected to accumulate the positions now near that of the low and start gaining the levels. So this is what the market reading is, identifying the type of moves they are doing it, and then we try to take the positions. So even though the forecast was recommending a sell and buy trade, I have not entered into that of the sell and buy trade even though the drop was expected, because the drop is expected to be very sluggish. If it would have been during that of the Japanese session, then we could have taken a sell position. But during that of the European session, where they are expected to gain the levels, but they did not gain much. So automatically, when the gain is not significant, the drop will also be not significant. That is what we fine tune. And it will be a sideways move. And then subsequently, they are expected to gain the levels during that of the US session. So that is what is being derived. So now we will come in. If you have got any question, you can ask me the questions regarding the trades so that I'll explain to you. If there is no question, then I'll proceed to that of the explanation for the my trading system for those who have come during that of the US session. So my trading system consists of the three components, namely the derived forecast and fine-tuning the derived forecast using the market trading technique. Then I use the trading strategy, but I give more importance to that of the trading strategy because the forecast need not be 100% perfect. There can be an element of error in our estimate. So in such a situation, we should not incur loss in our trade. There comes our smartness. Then I focus more on the trading strategy using the hedging so that we'll be able to really understand that we are not going to face any big drawdown in the account. So handling that account and earning consistently from the market is going to speak about our trading system and not the forecast. I can simply say that euro from that of 1.05, it can go up to 1.09 level. And when it goes, then I can say that, see, I have given the forecast and it's gone up, fine. But what is the benefit out of that? It should be reflected in a trade. So more than that of the forecast, we have to focus on that of earning process. In that, our trading strategy helps a lot. So what we do is we look into that of the live market quote page, and this is going to be the only tool which will be referred during our trading, so that it will be very simple to follow. And once you read it very carefully and at ease also, you'll be able to recognize immediately the intentions of the players and develop the skill set only by looking into the live market quote page. Don't get yourself distracted with the charts or with the help of other type of technical analysis and fundamental analysis, because those things may say the market is expected to follow some sentiment, but the players create the market sentiment, and the sentiment happens to be a short-lived sentiment, and then they simply reverse. So if you follow the sentiment and try to take position, and if the market reverses quickly, then we are trapped. Also, there you don't come across the timing of entry and exit. We only talk in terms of levels. Okay, this is the support, this is the resistance by various type of analysis, and then near that of the support we try to buy, near that of the resistance we try to sell, or we go in for a trade like breakout trade. Above that of the resistance we try to buy when the market goes up, or below that of the support we try to sell when the market breaches. But such trades can be trapped, and it is nothing but a speculation. Instead, if you read the intentions of the players, what they are trying to do from time to time, then accordingly we can plan our trade and successfully earn money from that other market. So for that, what we do is we note down the initial lows and the highs around 3:30 GMT. So this is the forecast sheet. So the forecast says that they are expected to make the gain, but the gain was not significant, and then they are expected to drop. But what has happened, they made the drop first, and then so they are expected to gain the level following the swing and form of move anticipated by tomorrow. Then coming to that of the market reading, I noted down the initial lows and the highs around 3:30 GMT, and then when you look into that of the market, you find that still euro is below that of the initial low, and they formed the low around 1.0547. Then subsequently they breached it to came down to 4.3 and finally came down to 2.2 and hitting the stops and start gaining. So during that of the gap time, they just gained the levels in the case of euro. So during the session, they are expected to make a small dip again and as a false move. And so when they do it that way, immediately the traders will think that euro does not have a support, does not have a strength to go up. It is better to go in for a sell and buy trade. So immediately the traders try to take sell. But what the players do, they go up to that of the low, or if needed, they may hit the stops below that of the new low and then start recovering the levels, because you don't come across much of a significant drop by end of the European session. And even in the case of GBP, they are done only about 75 pips net change level. So whenever they make 75 pips net change level, they are expected to reverse the market without much difficulty. Then, in the case of GBP, it came down to 1.2446 and below, still holding below that, but it was only a sluggish drop to 1.2384, and they are holding below that of the initial low, and they are likely to gain the level from that of the mid US session. So during the US session, watch for 30 minutes, that is 14:30 to 15 GMT. And if they don't breach the new low till 15 GMT, you can take a buy. And if you want to do the gap time trade, you know that gap time moves a false move. And when they formed up, they are expected to slide. But the slide between the formed up level to that of their low, hardly it is about 7-8 pips. So instead, we can wait for the market to dip and then try to take the position. And in the case of USDN, they just made a quick rise and stopped cutting the new low, new high. So here we can keep the sell order near that of 114.92 and then wait for the market to fill and come down. Then in order to gain the levels in the case of Euro and GBP, they will quickly make a drop in the case of USDN and then start gaining the levels again. That is what they just do it in order to trigger the market. So they make in some currency a quick move, and that quick move will reflect in all other currencies for the traders to take positions. Many of the occasions you would have noticed that GBP they drop. So once they drop GBP, many traders will think that there is no point in selling, already it has made the drop. Then immediately they will sell US Euro, thinking that it will also fall. But we have to see the net change and find out how far they are going to drop. And in that case, if that drop is less than 75 pips, then obviously they are not going to make a drop during that of the US session in a big way. That means either the volume is less or the players find that traders are taking mixed positions. That is, some traders taking long, some traders taking short. And then they have to only make either way stop ends, and there is no point in making big drop. Even though the data might be giving some trigger for the market. It might be, say for example, you come across phenomenally positive data for US dollar. Still, you may come across Euro and GBP not making a very significant drop. Why? Because there is not much of a volume in the market for the players to drop, or already the traders have taken sell position anticipating the data. So in that case, they will make a small dip and then start gaining the level and say that suddenly there is a risk appetite entering into the market. So they can twist the interpretation of the market comment from time to time, so which we need to understand. So what we have to do is look into that of the live market code page and find out how they are making the moves in the market. That is more important rather than simply indirectly analyzing the market. So in the case of USDN, they just breached the high and went up and then formed the new high and then stopped cutting the new high. We'll watch for first 30 minutes in the US session, and then you can take a sell position. In the case of USDN, they will make a drop to 114, make a brief downward stop, and before making further rise to 115. So either way moves, they make it in the case of denominator currencies because of lesser volume in the case of denominator currencies. In the case of USD/CHF, they just breached the low by briefly and again by the high briefly. Not a significant move you come across here. It has breached the high and come below that of the initial high. In the case of USD/CHF, Canadian dollar again, they went up and above that and still holding it after making a brief upward stop, and they are expected to make a slide. That's what I was telling you. They wanted to gain the level, and then after making upward stop, they made a downward stop, and then subsequently an upward stop, and again they are expected to make a downward move. In the case of Australian dollar, they come up to that of the initial high, 76.55, the initial low, and holding it. See, you can understand how initial lows and the highs play a vital role, and these are all the levels the players are using it for their understanding of how the traders are taking positions. So if you follow the same, we'll be able to read the intentions of the players. So with the help of the live market quote page, we can identify what sort of moves they are expected to make. Then also, besides reading that market, in which way they are going to do it, we need to understand the session timings so that we will follow the time, and during that time we'll be able to enter and exit out of the positions. So during that of the gap time, 14 to 14:30 GMT, they are expected to make a false move, and now we find that Euro and GBP have formed up, and USDN has made a dip. But subsequently, from 14:30 onwards, they are expected to make a reversal of it nominally, but it will be a sluggish move again. And then, because in the case of Australian dollar, they come up to that of the initial low, but not reaching and going above, indicating that they will make one more dip and then start gaining the level, or at least make some sideways move for 30 minutes and then start gaining the levels. So for that, we need to understand the timings followed by that of the players. So I'm having a GMT time frame here. Exactly by 14:30 GMT, you can see how exactly they are reversing the market, or how exactly they bring in sudden volatility in the market. We'll be able to watch it. And similarly, 13:30 GMT, the data release time, how they are making a move. If you look into that of the candle formation in the chart, when the market is sluggish, making about 5-10 pips, the chart will be magnified. And suddenly when they make a big rise of about 20 pips or 25 pips, then immediately the chart will show the green candle in a very big size. And immediately that will trigger your emotion, market is going to go up. But actually, if you look into that of the net change, you know that hardly they gained about 20 pips. So for that, if you use a figurative chart, then it magnifies such a rise or the drop, and which induces your uncertainty and the fear. Thereby, if you are holding a favorable position, you become greed. If you are holding an unfavorable position, you become panic. So under the influence of greed and panic, or under the influence of emotion, one is supposed to make distress trade or miss great opportunities to book profit. As a result, you come across the traders say that, okay, I was having a great opportunity to book profit, I missed it. That's what they say, that market is crazy. They don't accept their folly. Instead, they comment on the market. Similarly, when the market goes up for 20-30 pips, immediately some people start yelling. They're all nothing but the emotional expressions. Just making a big noise when the market is going up, or making just to cut a sorry face when the market is coming down, is not going to help in trading, which will only trigger our emotions. We become frightful, and as a result, we tend to make some wrong trades. Keep always in mind, only the calm people will be able to successfully earn money from that other market. And that is why you come across in all the uh, TV shows where they are giving the market comments, etc. They always present it so emotionally in order to trigger the emotions of the traders. They are all paid to misguide the traders. You might think that it is a free show, you are able to really understand about the market, but actually they are all pre-planned, and you will not be disclosed, and you will be thinking that they are doing a great job of giving a free service, etc. But they are all nothing but to misguide by triggering our emotions. So ultimately it is our mistake. When they induce us to become emotional, we should not become emotional. There comes our skill set. How can we avoid becoming emotional? Only by reading the intentions of the players, nothing more than that. Once we read the intentions of the players, by identifying the type of moves they are doing it in that specified time frame, then we know what sort of moves they are doing. Always keep in mind the quick moves or false moves in the market. Slow moves are intentional moves. So whenever they are making intentional move, slow move, you take position in line with that other move. Whenever they are making quick moves, you try to go in for a contra trade, and you know that they don't make hat trick. When they gain the level first time, watch how far they are gaining. And then when they gain, breach that new high and then gain further, then that will be the level they gain. The third level they gain, but they become sellers. First two gain, they become buyers. The third rise, they hold high and sell. The next day, you find that it starts dropping. And they put overnight interest for the traders so that the traders are afraid of carrying the positions to that of the next day or during that of the weekend. So how they are able to control the traders by such structuring? No, they have the structuring of the stop-ons. They have the structuring of giving the margin call if you trade without the stop, and they charge overnight interest when you carry the position. When the interest rate is so low in all the parts of the world, why they should charge a big interest on the positions? So they are all specifically structured in such a way to trap the traders. So they make less than 30 minutes two type of moves, namely stop and false move, and above that more than 30 minutes and up to 2 hours as an extended move, which is again a quick move. All these three are quick moves, and only the intentional move is a slow move, and that will be pip by pip. So swing, they will also make it as a similar to that of the intentional move between the high and the low in order to handle the crosses. So we need to understand that what they are trying to do it. If there is a quick upward rise, watch for the third rise and take a sell. If they are making slow rise, then take a buy and book profit. But you will be able to understand this. Then they are expected to make the swing for about 15 to 23 pips. So if you keep 30 pips stop or the hedge order, then the chances of getting filled will be lesser in a normal market. But during that of the data release or during that of the month and time, they will make very volatile move because monthly trend reversal they are expected to make. During that time, if you use 30 pips hedge order, they might hedge quickly. In that event, you have to keep stop at entry and then try to book either way profit or avoid taking position during month end. That way, you will be able to consistently earn money by doing swing trades. Most of the traders, they get the margin call or they close the positions in distress only during month end. avoid during that of the first week and the last week of the month taking positions. You will be very comfortable in simply holding the position and booking profit. In the event if the position is hedged, you watch for about 10 to 30 minutes. And if the position is not making profit, by experience you will be able to understand that they are not going to show profit and that you can just book a small loss or keep stop at entry and close it, or book a small profit of 1 or 2 pips and keep another hedge order 30 pips below. And once they start gaining the level again, bring it back to the original level. So this you have to consistently do that. Only then we'll be able to limit the risk. If you simply keep the hedge order and then attend to another work and they gain, and by the time you don't trail the hedge order upward, and then again if they drop next day, you say that I'm hedged again, then you have to be blame yourself because you are not monitor the open position. When the market is making unfavorable position, you have to be alert and then take appropriate decision and close the position either with the profit or with the loss and book profit on that of the hedge. Thereby you will be able to get the net profit. Otherwise you can just book profit on either way. During the downward move you can book profit, and during the upward move you can book profit alternatively. Now 1431 you find that they started making the dip. Now you can understand how systematically they are making the moves in the market. Then you will be able to appreciate the timings what I have noted down about 22 years back. Still it is valid. We are not changing it. So we don't have any fresh position in euro because already we have closed it. Now this is the gap time over and the new session starts. So we can take fresh position in the case of euro. As I told you that they are expected to make a small dip and then go up again. So we'll keep a buy limit 1.0525 closer to the other low, and keep the hedge order 1.0495 and take profit order. We'll keep closer to the other high, initial high. And in the case of GBP already we have a position so that we can carry forward. In the case of yen, they are expected to make a dip because they are just gained up to that of 114.95. So we can keep a sell limit 114.94, just one pip below that of the high what they are set. And then the hedge order, the buy stop 115.24, 30 pips above. GBP and Australian dollar we have a old position, so those things we can carry it and see that when they gain the level we will be able to book profit. So these are all the trades now recommended based on the market move. As I told you that they have made only a slackish dip, and we have to wait till 15 GMT to see how far they come down. Then afterwards you can take the buy position. If you got any doubt you can ask me. I'm willing to answer to those questions. So fine-tuning the forecast using the market reading is vital, and for that we use only the live market quote page. No other tool is being used. I stopped using it for the past 19 years. Before that I was extensively using it being a statistics professor, and found that however smart you are in your doing your analysis, the market differ or deviate from that of the expectations, and we are not in a position to give the exact forecast, then immediately all the analysts start giving the disclaimer that the past performance does not guarantee the future. But when I give a disclaimer of that nature, how do you expect anybody to follow me? This was lingering in mind, and because of that, I just gone in for advanced statistical analysis and sequential analysis I made in order to find how exactly the market has to be read, following the influencing factor, the extraneous influencing factors of the market. And finally, combining all those statistical analysis, I was able to develop a sequential algorithm with which I'm able to give the forecast for the entire market, which is really working for so many years. So then I found out that the players are being influenced by the extraneous factors. So even though they are manipulating, they do have the human limitations. Because of such human limitations, they are also expected to make such knee-jerk moves in the market. So we should be able to read it. And because of that, you come across that even the high net worth individuals and the banks are taking the forecast from me. Uh, I'm not trying to boost myself because they know that such knee-jerk reactions are vital for them, because when they are trading in big volume, so they wanted to know when exactly such influences could happen. Because I was aggressively giving it in those days, even in 2001, that September 11th, there was an attack. And I gave the forecast on that day that US dollar will be under severe pressure. And I gave the display in FX trade at that time. And everybody was telling that how exactly you know. And that is how the forecast has worked. And then people started following it. I was telling that then again, the market is expected to not to reverse. US dollar is expected to weaken for nearly about 9 to 10 years. But later on, I found that there was a sudden drop in 2008. Then I realized that there is a multi-year cycle which I was not looking into it. Then later on, I just incorporated that also into my calculations. And now we'll be able to say when exactly the next multi-year trend reversal is going to happen. So this is how the market has to be understood. So why I'm telling is reading the intentions of the players is vital rather than simply using the technical analysis and fundamental analysis. And they will work very well if the market is not manipulated. So now you can understand that the dip is very brief. They started gaining the levels. Even though they made around 1330 GMT, the dip and the US data was positive, but what happened now? They are simply reversing the market. This is how they create the market sentiment and act against it of the traders. If you got any doubt, kindly ask me the questions. I'll be willing to answer to the questions. See, I am giving the forecast and also explaining to you the market reading for small traders. Your only job is use the trading strategy effectively and try to earn money from the market. My contact details are here. My website address i-noindices.com. If you want to know further about the trading system, if you want to discuss with me regarding this analysis or you wanted to get some help, etc., you can always contact me through email or Skype chat. And they are not I will not attach any strings. I will in fact discourage you subscribing for it because my subscriptions are very high. But I want that those who can afford to subscribe can subscribe. Others can get the free advice and still they'll be able to get the benefit and trade successfully in the market. Then I'll come back again on Friday, day after tomorrow, to review the Asian session live market analysis, what I had given it on Monday, the forecast, and explain to you how exactly the market has made the moves during this particular week. Normally, every week beginning, I give the forecast for the entire week and also the levels in which they are expected to swing the market. And I will review it and show you how such calculations are reliable. Since there are no questions, so I take this opportunity to thank FX Street for the facilities provided to present and interact with you people. And I'm very happy that you are able to understand that the market is being manipulated. So trade wisely and use your smartness and use your logistics while trading. Don't become a blind trader or following simply the technical analysis, and use your common sense from time to time. That will be able to really help you to limit the risk. So wish you all the best in your trades. See you on Friday.